Welcome back to Dukascopy TV. I'm Elaine Stenson and I'm joined in the studio now by Dougal Thomson, who's the Director of Communications with the International Publishers Association here in Geneva. Dougal, you're very welcome back to the studio.
Thanks, Elaine. Nice to be here.
So we're going to start today by talking about Google. Can you tell us about their latest acquisition?
Yeah, they've been spending big money. They bought a company called Nest Labs for $3.2 billion. Nest Labs make smart thermostats that can control the temperature in your house via your mobile phone. They also make smoke alarms and carbon monoxide alarms. It's a small company, it's only 300 people, and Google has paid quite a hefty premium, about 10 times annual earnings of $300 million.
And why have they spent so much money on this company?
Because they can afford to, and they've made billion-dollar deals before. If you cast your mind back, in 2006, Google bought YouTube. In 2007, they bought DoubleClick, an advertising services company. And in 2011, their biggest deal to date was $11 billion to buy Motorola's mobile phone business. With Nest Labs, they've acquired a very talented team of ex-Apple engineers, people that know how to design and develop great products and how to integrate hardware and software. That's going to be very helpful to Google, and it's in line with a number of other recent acquisitions they've made. They bought Boston Dynamics, that's a military robot maker, last month, and they bought a human gesture recognition startup in October. These are the kinds of firms Google seems to be targeting now.
So we need to stop thinking of Google as a web search engine company.
Yes, please just forget about them as the search company, because there's so much more than that. Google has bought 142 companies since 2011. It's a lot of companies, and they've increased the speed recently. They've bought 11 companies in the last 6 weeks. When you look at Google's portfolio now, there's some there's some weird and wonderful firms in there. Just to give you a few examples, there's 23andMe, which is a biotech firm that allows you to do a very rapid DNA test that tells you if you're susceptible to particular genetic diseases. They own Makani Power, who make wind turbines. They own Kabam, that's a computer games company. And they own Whittleby, that's a children's clothing firm.
It's a very, very diverse portfolio.
It is, and I suppose one reason for that is Google's rich enough that it can afford to hedge its bets and take chances on a bunch of different kinds of companies in different sectors. But it's not quite as varied and scattergun as that. I mean, they are focusing now on a few key areas. One is robotics. Another sort of key term for them is connectivity. So that, Nest Labs fits into that. They're also interested in what's called the Internet of Things, which is where you have a microchip installed in any device or person or animal that can be communicating over a network without the need for humans to get involved. They're interested in the health sector in a big way. Yeah. We see them investing in cancer research and autism diagnosis firms. And then there's Google Glass, these wonderful new spectacles that you can wear that deliver this enhanced reality experience.
And do you have a pair of Google glasses yourself?
No, I've yet to see anybody walking around Geneva wearing a pair, yes. But I would like to road test one. Okay,
I want to move from Google now to the Chinese economy, and they've just released their GDP figure. What have they said?
Well, they've said that in 2013, GDP increased by 7.7%. Which is higher than the government's own target of 7.5%. 7.7% sounds great to us sitting in Western Europe, but that's actually the smallest GDP increase since 1990.
So are these figures bad news?
Depends who you talk to. The Chinese government will say, no, this is fine, this is over our target, and besides, we're in the process of slowing the economy to a more sustainable rate, and we're rebalancing the economy away from depending on investment and credit, going towards being driven more by consumption and services.
And what do the markets think?
Well, pretty skeptical about this. I mean, when these figures were released, Asian stocks fell. I'd say the overall mood's pretty gloomy. There's a lot of skepticism about whether the Chinese economy actually is rebalancing at all. And anyone that goes to China will tell you that there are still these giant construction projects underway. They're building the world's tallest skyscrapers, the longest bridges, the roads to nowhere, giant shopping malls, millions of new homes that nobody's living in. And at the same time, you've got a lot of concern about rising levels of bad debt. I mean, the Chinese model was predicated on Chinese banks making huge amounts of loans, and there are fears that a lot of those loans went into unproductive investments and the banks aren't going to be able to get their money back.
So the question now is, where does the Chinese economy go from here?
Well, it won't ever be growing at the double-digit rates that we got used to seeing in the past. The new Chinese Premier Li has said that 7% is the lowest acceptable growth rate for the country, but even hitting that is going to be hard. And two reasons. One reason is demographics. We think of China as this, vastly populated country, but actually the working age population shrank last year and it shrank the year before that. Now the Chinese have just relaxed their one-child policy, which is great, but that's going to take 20 years to actually, have an impact. And a shrinking workforce inevitably means shrinking productivity. And on the other hand, but they've only gone part of the way really to reforming the economy, and there's a lot that still needs to be done to provide the right conditions for growth. One thing that they've done, which is quite interesting, is in Shanghai they've launched a free trade zone where they're going to, it's going to be like a test bed for opening up the market. Sectors like financial services and telecoms, which until now have been really sort of tightly controlled in Shanghai, they're going to open these markets up to foreign firms. So foreign firms can operate call centers, they can provide home internet access, they can build computer games consoles and sell them across China. And they're also going to allow interest rates to be dictated by the market, which is quite interesting. I would think, thinking about China, we all now accept and agree that the current economic model based on investment and credit just won't work going forward. So it'll be interesting to monitor this Shanghai free trade zone and see if that experience opens up new, different avenues for growth.
Okay, Dougal, thank you for joining us in the studio today.
Thanks, Elaine.
And that's all we have time for now, but do check back later for further updates and interviews from the Dukascopy TV team. Bye for now.